Good morning, everyone, and welcome to this first session of our webinar series on preparing early stage innovations for investment readiness. My name is Siebe Briers. I'm an expert at the European Forest Institute, and I'm also the deputy coordinator of the Bioregions facility. It is my own and our team's pleasure to organize this webinar series. To give you a bit of background, the Bioregions facility is a platform for regions to learn from each other and to collaborate to advance towards a circular and forest-based bioeconomy. So these webinars wouldn't have been possible without the great support of our Bioregions member regions, which are the Basque Country, Catalonia, North Rhine-Westphalia, Castilla-Leon, and the Austrian regions. I invite you all to learn more about them on our website. It's really wonderful to see so many of you joining us today, researchers, entrepreneurs, technology transfer offices, and everyone interested in this important topic. Your presence here already signals something very important, that there is a growing awareness that having a good idea is not enough. To make an impact, innovations need to reach the market. And that is precisely the challenge this series aims to address. And I don't have to tell you about the potential that the forest bioeconomy holds for the environment, society, and economy. From a technological perspective, there are endless possibilities to transform key economic sectors by using circular bio-based materials. Besides, Europe has a leading bioeconomy research community, but despite this, Europe still struggles to bring new bio-based products and services to market at scale. A key reason is what we call the valley of death. It's this critical phase where a promising innovation has moved beyond the lab, but has not yet reached commercial viability. And as the EU bioeconomy strategy makes clear, there are in fact two such valleys. The first valley of that is the gap between early stage R&D and pilot or demonstration scale. It's this phase where public research funding is running out, but private investors are not yet ready to step in. And this is exactly where many of our most promising forest-based innovations get stuck, and at the same time an issue that some of you or attendees have to deal with. The first valley is where investor expectations, business model clarity, and the ability to communicate value become really decisive. And yet, for many research teams and innovators, this is precisely the territory that feel most unfamiliar. So what are we doing about it? In our recently published Key Messages report on scaling up forest-based innovations in Europe that dives deeper into the scaling up challenge, one of the core recommendations is to provide training and foster business mindsets of researchers and early-stage entrepreneurs. So therefore we organize these webinars. You might know that there is a wide array of universities, technology centers, and early-stage innovators working on forest and wood innovation inside our bioregions member regions. Besides, the European Forest Institute has about 130 member organizations representing mostly universities and research institutes. So you can imagine that all of them combined really represent an amazing pool of innovators that can benefit from better understanding early stage investment aspects. So for that reason, we are organizing this webinar series. So now over 3 sessions, today, the 31st of March and the 14th of April, we will give innovation teams a clear and practical introduction to early stage investment. Who investors are and what drives them, what it really means to be investor ready, and how to navigate the investment process once interest is secured. So with that, let me now introduce you to our expert. For all 3 sessions, we are delighted to be joined by Jan Debets. He's a manager at Meta Group. Meta Group is a European leader in research, commercialization and innovation finance, with deep expertise in partnering with academic researchers to bring knowledge to market. And they are also active as exploitation partners in major EU-funded programs and also invest through their own venture capital funds. So, Jan, feel free to complement anything you want about Meta Group and about your own background, because the floor is completely yours. You can share your screen.
All right. Thanks so much, Siebe. Thank you, Siebe, Leah, and all the colleagues at the EFI. It's truly a privilege and a pleasure to be with you. We have a lot to get into, so I hope you've taken your coffee and something sugary, because it's going to be a packed session. We don't have a lot of time, and at the same time, we have a lot of time. because we have 3 sessions. And the first one is really a sort of giving a view of the landscape, really starting from very high and then slowly zooming in into the world of venture capital to provide you with sort of the context and the understanding of really the position of how investors operate and what drives their behavior. Because the key assumption of me, Siebe, and everybody of the organizing team here is that understanding how investors operate will increase your chances of success in the fundraising process. Before that as well, I really encourage you to add me on LinkedIn. So I put my LinkedIn link in the chat and feel free to email me. At Meta Group, we are here to help you to get your knowledge to market, as our tagline says. So it's really great to see all of you, such great interest, and looking forward to meeting each and every one of you individually to see what we can do to support you in this difficult process that is innovation. So let's start very quickly about myself. So I think it's always worthwhile to talk to you about my biases. So why do I think I have the authority to talk to you about these topics? That's a very good question. I ask that myself every night. I think I have a background mostly in angel investing. So I've worked the last decade with high net worth individuals and thinking about ways to entice them, help them, build an ecosystem or a set of processes around them to help them invest in startups, in very early stage, high risk startups. I have also a little bit of experience in venture capital at a Silicon Valley based fund, as well as in a fund in the Netherlands, mostly investing in software. And this software background to a degree is helpful because it's sort of the creator of all assumptions and the lingo around investing comes from the software industry, but that's not entirely applicable to deep tech, as we will see later. But mostly my background is in angel investing, and that gives me sort of a view into this world, but a very small view. And that's why I also want to make the view very large in this webinar series to understand how this tiny fish operates in a larger ocean. So Meta Group very quickly. So we partner up with research teams and innovation journey. We provide hands-on experience in accessing market and financial opportunities. We like to call ourselves research angel. That means that we embed our startup expertise really within the research teams and sort of invest our time and competence and eventually capital to share the risk with the researchers. And this sort of long-term commitment sort of stems from our understanding of what equity investing is, namely you take a share in the company and you are partnering for a very long time. This long illiquid period is something I will keep returning to, but it speaks to the marriage you need between investors and researchers in order to bring the innovation journey to success. And we're there for the long term. How do we do this? Through our acceleration program. So every engagement we have with researchers follows sort of these different modules, from competition analysis, market definition, all the way to intellectual asset strategy. This is extremely important, of course, as you know. And then finally, on the bottom right, access to finance, which is my expertise. We do that amongst others, indeed, as Siebe said, by being a dissemination and exploitation partner within the TRL 1 to 6 phase, mostly in the programs and instruments you see listed here. So that's the EIC Pathfinder, EIC Transition, the ERC POC, and of course, the many Horizon Pillar 2 RIAs and IAs. I've not listed here other funds like the European Defence Fund or the Biobased Consortium, but they flow through Horizon. So as Siebe said, we also are an equity investor and we have a long-term track record here. And the exits here are the most important. It means that we have invested in a company and also got out of it with a profit. It's the lifeblood of investing, and it speaks to, I think, the success and understanding we have of this full innovation journey beyond European projects into first investments, into entering the market, all the way up to putting your company on the public stock exchange, an IPO, or selling the company to another company. So, and beyond our own fund, Our partners and our employees sort of have double heads here and there. So we have lots of employees that are founders of angel groups, such as myself, or have managed angel groups, or are partners at other venture funds. So we think we have a true competitive advantage when it comes to that combination between understanding the EU speak of grants and the venture capital world. We sort of can be that bridge. Now, as Siebe said, this is one of three. This is really a top-down view of the world of investing to really slowly descend into what we call the early stage of investing. And I think in webinars 2 and 3, we will be way more practical. So that would be also, I think, the opportunity there for you to ask very specific questions about your own innovation and how it relates to access to finance. Well, I'm already sharing some key takeaways with you, showing my cards. There's a lot of words on the screen here. I'll just go through them very quickly. So, of course, access to finance is a crucial bridge to the valley of death. Understanding investors and speaking their language will increase your chances of success. Venture capital is a subset of private equity and is similar in the degree to which the investments are locked up for a very long time. And this has lots of consequences for everything in the game. Crucially, you need to understand that venture capitalists are a product to other investors, LPs, as we call them, limited partners. And these LPs are in the market for many different products. So venture capitalists are in a very competitive environment. And because these venture capitalists invest very early stage into loss-making startups, their fund mathematics follows a very unique law called the power law. This is important. And then, although European VCs use the same language as the American VCs, where this whole industry has been founded, it has a very different makeup with serious consequences. And finally, business angels and venture capital funds are similar in the degree to which they invest in shares into a loss-making startup, but they have very different incentives and very different outcomes, therefore, in terms of their behavior. Okay, well, I added some shares on bio-based ventures, but Siebe already shared this one, so I'm not going to spend any time here. What I did want to share with you is that you operate in a very niche space, but it's getting funded seriously. So I've on the screen now the amounts of funding wildfire startups have received over the last couple of years, and that's a serious amount of money. What I want to do is share a couple of more lists, but as I am an investor, I need to pay for this service. But if you're an innovator, you can use platforms like Dealroom free of charge. So I'm putting in the chat right now a couple of links that can sort of give you a sense of what kind of other startups are there. So, for example, in the forestry or in the fungi tech, so mycelium, and you can also go to this LinkedIn post. These are all great ways of understanding other startups and investors who operate in the space. Just giving you a couple of examples. So, in the forest fire field, you have a Dryad Networks. They've raised 10 million for developing their IoT solution. Then you have in the fermentation side an Italian company having raised 11 million lately, and they transform residues from the forestry industry into functional low environmental impact high value materials. And then I see Igor Barchera have joined us, and he might be interested with his startup looking at Voodoo from France, having raised 31 million, and they transform low grade native wood into sustainable materials. Okay, serious amounts of money is being invested in this. So I think that's promising for you and your innovation. So it also means that there are investors here. I'm going to skip this a little bit because this is too granular, but I think you get the point. But now let's go to the theory. As I said, I want to take a little bit of a high level view, a little bit comically high maybe, but I think it helped me, having studied history, sort of navigating this world of finance. I am not trained in finance, although I have worked in the financial world. And for me, as an historian, it's always good to understand the context and sort of the background, the decor, if you will, to understand what that means to influence the actions of people and actors. So the theory, let's start with the theory. And the theory comes from the United States. So what is finance? Because if we're talking about investors and they operate in the world of finance, And what is that? To be very simple, it is the interplay between those that have and those that need capital. That's what finance is all about, that interplay between the two. So let's take an example. I think a great way to understand the world of finance is actually the biggest players in the world of finance by far are pension funds. They have capital because they need to secure steady retirements for those who paid into the fund. However, they have lots of pressure because the fund that they operate is losing 2% of its value every year to inflation. So they seek to find actors that need capital. And that often is a business, can also be a government, but a business needs to grow. It needs to finance materials upfront. If you want to start your cafeteria, you need a frying pan. You don't have the money. So you need capital, and you get that capital from actors that sort of are under pressure from inflation to sort of keep their pot alive and obviously want to maybe even grow it even better. And in between those that have and those that need are intermediaries. And these are what we call the investors or the investment managers. And they follow very simple, I mean, obviously comically simple creed, naming buy low and sell high. And this is an oversimplification, but I think the selling part is often forgotten by entrepreneurs who start engaging with investors because investors are there ultimately to sell their stake into your company with a higher value than that they entered with. This is simple but often forgotten. Investors are there eventually to get out, and they do a lot. They will do a lot in order to do so to get out. Now, pension funds I like as an example because it's a great way to visualize how this market works, and this market is huge. So most investors operate in tradable securities. So these are, and also classical finance, financial theory and literature sort of operate in the box on the right. That's namely equities, stocks, and bonds. And portfolio theory is all about how much equity and how much bonds you have. And the thing about these tradable securities is that they are easy to convert to cash. They are easy to trade. And they are also extremely highly regulated. For example, the stock market, you need to do quarterly reporting to your investors. So there's a whole sort of world built around the regulation and sort of the rhythm of the financial markets. And these are huge. So 134 trillion for equities, 145 trillion for bonds, and you have sort of a degree of returns. So namely the amount of money extra you get on your pot when you invest in such a security. On the bond side, this is a little bit lower, so it's a low risk, low reward, but you can sort of almost expect a certain return. You call this almost the risk-free rate. For example, if you buy American government bonds, you always get a certain degree of interest on them, and they are so safe. Investors feel that this is sort of the floor of the investor expectation you have when you enter the market. This is very important when we go to private equity and venture capital. On the stock side, for example, the S&P 500, the most important 500 companies on the American Stock Exchange, if you invested only all your money in there, and the last 10 years, you would have gotten a return of 12% per year. This is quite extraordinary, but quite high. Unsure if that will last. But this is also, again, a sort of a benchmark where pension funds think about, okay, I'm entering this market to make a return for my pensioners. What kind of products can I buy? Now, and then you have the alternatives. So all the way on the left. And the alternatives long seen as too high risk for most investors. And still, I mean, if you look at the total size, it's very tiny. And this is all real estate, all private equity. But it has become more and more important over the last years. And the risk profile of alternatives is very high. And private equity is in alternatives, and venture capital is a subset of private equity. And one of the what are alternatives? Okay, high risk, high reward. So if you go to the left side of your screen, you see venture capital is a tiny subset of private equity. They have similar characteristics. They are very lightly regulated, so you don't have to do quarterly reporting. Everything is private. There's a certain structure there. You have the limited partner, for example, a pension fund, and the GP, the general partner, who sort of manages the investment. Okay, and that relationship is very important. And one of the crucial elements of private capital is the illiquidity period. very similar as when you buy a house. You have sort of value stored in that house, but you cannot really readily access that value. You really have to sell the house first before you get your liquidity. And that's how private capital is so different from tradable securities, where you can get relatively easily your cash back. And this illiquidity period sort of influences a lot of behavior and a lot of things around private capital. Now, if you go to the right, so VC is a sub-part of private equity. How are they different? Private equity invests in mature, profitable companies. They take the majority of the shares. They want full control of the company normally they invest in. And because they buy a lot more shares in bigger companies, they often need to also finance their acquisition with debt. And that's why they are very susceptible to rates. Then you have venture capital. They invest in loss-making startups, which are very scalable. They take minority control, often in different rounds. And those two elements, investing in small rounds, so taking a low equity share percentage, and investing in very high risk startups that sort of have a low chance of becoming very big. That means they follow the power law math, meaning venture capitalists rely on a single outlier within their portfolio to return the entire fund. Let's go on. So why would you do this? Why would you be like a pension fund shopping for investment products, invest some of your portfolio money into a venture capitalist? It's extremely high risk. Well, the venture capitalists themselves use a term called infinite returns. It's a bit outrageous, but it speaks to the degree in which venture capital is the only asset class that can provide returns that are orders in magnitude higher than other asset classes. That it means you get that lottery ticket and you might be part of big tech. The power of venture capital weirdly is shown very well looking at the stock market, because right now, when you look at the stock market in America, and indeed of the whole stock market of the world, only 7 companies are overrepresented. And it's never been the case that so little amount of companies hold so much sway over the global economy. Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. Not Meta Group, let's say Facebook. But also other companies you can think about, Uber, Airbnb. These are all now on the stock market, but they have once been funded by venture capitalists. And these venture capitalists have earned ginormous amounts of money. And not only that, they have created the world we live in, right? Since 2010, we entered the era of big tech, and they've created actions and behavior that we are all part of. And it's all been funded by venture capitalists and then sort of created this new class of wealth, personified, of course, by Mr. Peter Thiel. And sort of, I think the power of venture capital is sort of exemplified by the vice president in the United States, who is a protege of Peter Thiel. Peter Thiel is one of the first investors in SpaceX, Tesla, and Facebook, a man of dubious thoughts, but one of the most successful investors ever. And he now placed his protege in the vice presidency. This is also shown in amount of money flowing into venture capital. So enormous amounts of growth is now piling into this world of early stage startups because they all want to be part of that next wave of big tech. Now, let's take a step back. What is venture capital? It's about investing in loss-making innovation with enormous upside in various de-risking rounds, right? So you can see there is high risk on the left top side and low profitability of the company. And that sort of crosses in, let's say, so the more profitable the company becomes, the less risk it has. And sort of that changes the type of investor you see. So you see on the below that there's numerous types of investors, and every investor has sort of a degree of capacity to invest, how much money and capital they have available. And the less capital they have available, that means that they have to go earlier stage or higher risk to the higher risk part. And you have to see this as a sort of a relay race, because other than private equity, where they go in one time, they finance their acquisition with debt, and they go for more than 50% of the company. In venture capital, you have lots of different rounds, where every round there's sort of a new de-risking milestone, where you hand over, if you will, the lead to a new type of investor. So that means that you have a lot of different types of investors who all specialize in a certain phase with a certain ticket size, but it's a relay race. Right. So I talked about how VCs are a product for limited partners, and I think this is crucial to understand. So, what are VCs actually? They are the general partner and investment team, and they manage a fund, but they invest other people's or other institutions' money. And what do they promise them? A certain degree of return that is competitive with the stocks and bonds I've shown. And why do they say, can they do it better than a wealthy family or a pension fund? Well, venture capitalists say, look, we have insight into the market and we have proximity to teams that you don't have. So we do the selection for you, right? So that's crucial to understand this GP LP dynamic. Limited partners are those actually who invest the money and GPs make the decisions. So how are venture capitalists paid? They paid in two ways. First, they receive 2% per year normally on the stock size of the investment fund. This is also the case for private equity. They do the same thing. However, in private equity, you have funds of billions of euros, but the median venture capital fund size in Europe is 50 million. So what is 2% of that? You can charge 2% per year to your limited partners. They wire you the cash. That's 1 million per year. And for that, you need to buy an office, your lawyers, your accountant, and 6 employees. It's not a lot of money. Venture capitalists are not insanely high paid or something. Unlike our private equity brothers and sisters. So how do venture capitalists then make money? Well, they get 20% of the profit, let's say, of the capital gain of the fund. So you could say venture capitalists are incentivized to think about those profits of the fund, right? Because they get 20% of it tax-free in many cases, or with a lower tax rate, by the way. Or are they? Because these profits can come at a very late stage. And in the meantime, they need to pay their bills and see their friends in other careers earn a lot more money, but because they with their 50 million euro fund with 1 million in management fees, they don't earn a lot. So there's this sort of background incentives for venture capitalists also to enlarge their fund. Otherwise, I mean, their yearly pay is a little bit low. And that in turn influences the ticket size with which investors invest in. And that sort of then influences the lack of early stage venture capital because they need small tickets. Hope that was clear. So back again, what is alternatives? These are private capital. They're not tradable on the stock exchange. So once you invest, you're stuck. And the time path to exit, to sell your shares is very long. Can be 10 to 15 years. The goal is always to exit in 6, 7, but almost always it takes 10 to 15 years to get your investment out. And that means in order to get this yearly return that is on par with stocks or bonds, the exit value has to be enormously high, right? And that's sort of influences the thinking of venture capitalists. That's why the most important criteria for a startup they invest in is the scalability. Like, can this startup become high to such a degree that when I exit it in 15 years, the returns, if I've spread them out over a year, are actually competing in a good way with the stock exchange. This has other consequences as well, this illiquidity period. So because they can only invest a couple of years per fund period, they need to start raising new funds even before they have their cash back from their first investments from the first fund. So they need to say, look, the value within my private portfolio has risen to such a degree that I can convince new LPs, new pension funds, for example, that I can produce that value in a new fund as well. And that's where you get the word unicorn from. A unicorn is a very famous word in the venture capital industry, and it speaks. It says like that a company is valued 1 billion euro or dollar or over. But this long liquidity period also means that VCs really needs to look into the future and then imagine a world where their technology investing now is fully in use 10, 15 years later. And that's this kind of mindset. This makes venture capitalists so different from other types of financiers because they don't look at they need to imagine companies that are big 15 years in the future. And I think a great sort of personification of this way of thinking is a very successful venture capitalist, business angel, and founder from Austria. He's called Andreas Klinger. He's also now a famous lobbyist. And he has he's so successful, he can raise his funds by himself. He doesn't need a team. And what he says is I tell all my LPs, I cannot promise you returns. I can promise you it's insane. It's sort of an almost grotesque stereotyping of what venture capitalists do, but in a sense, he's obviously correct because he's thinking extremely big, extremely into the future, and that's the way you need to think because of these long illiquidity periods. Back to Peter Thiel, he once quoted, or in his famous book Zero to One, he says the biggest secret in venture capital is that the best investments in a successful fund equals or outperforms the entire rest of the fund combined. That means that every investment a venture capitalist makes needs to be able to provide all the returns for the whole portfolio. And this is what we call the power law. Okay, so that you have this is a better slide. This is a typical power law, if you will. And this even works for the most successful investment companies in the world. So Y Combinator, for example, this is a very well-known incubator in Silicon Valley. And even there, if you look at their portfolio of hundreds of companies, only 4 of them provide 84% of the value created. This also counts for funds, by the way. So only a small number of funds, venture capital funds, generate big returns. And if you look at the money on money multiple and then extrapolate that into what the internal yearly rate of return is, it's only 2.8%. And compare that 2.8% with the stocks and bonds I shown earlier. And that gives you a sense of how hard it is to make money for your LPs. Summarize. So VCs offer a product to LPs in a very competitive environment. So venture capitalists are regulated professionals who aim is to provide a return. They compete with other asset classes. They have a long illiquidity period, and they operate in a difficult environment. So if you go to the bottom bar, they say 90% of startups fail. This is a very famous trope. I think I will come back to this later. This is not entirely correct, and this is, I think, one of the crucial lessons you should keep in mind. Right, here we are, 90% startups fail. So this is, again, one of the most famous tropes in early stage investing. It means the sayings, this is what everybody says. Is that actually true? So if you go to one of the most important limited partners, so the institutions that invest in venture capital and the funds that in turn invest in startups, this is the European Investment Fund. This is EU money, who they are funding venture capitalists in order to spur the innovation engine in Europe. And they've made a study of all the companies in all the various portfolios of the funds they invest in. And they've actually seen that the largest amount of companies, the blue one in the pie chart, they sort of dub them commoners, actually have 20% year-on-year revenue growth. That's actually an interesting data point. It says actually that no, most companies actually are relatively successful in the sense that they acquire new customers and attract new revenue, which sort of is the basic metric for company success, you would think. And that speaks to, no, not 90% of startups fail. 90% of startups fail to make returns for investors. Okay, so this is, I think, a crucial takeaway is that a lot of investors will tell you you will fail. No, there's a large chance that you will receive an investment and make a decent SME out of it, but you won't make a return for investors that can compete with the stock and the bond market. So again, that's the difficulty of venture capital. So with the above in mind, investors are extremely selective, and this is the topic we will come to in webinar 2, but this is sort of a typical funnel you would see in any venture capital fund, is that you see a lot of startups, actually only a small percentage of them you will actually discuss at length. Even a smaller percentage of that, or what's also 10%, but even a smaller amount, let's say 10, you will actually give an offer. You say, I'm willing to invest, with the caveat that the due diligence will be successful. Then you only do a couple of startups that actually you do thorough due diligence in, and then you only invest in 2. Out of that 2 of the portfolio, only 10% provides the return on investment that you need in order to be competitive against other types of investment products. So what do venture capitalists do? They try to protect their downside. And this is what we do in webinar 3. What are the tricks investors use in order to limit their downside? And a sort of a grotesque example of this you see on the right. This is a company called FanDuel. They've raised an enormous amount of money. sort of a mark of success and the promise they have, 416 million, and they've raised it with a certain valuation. That means the share price the investors bought the shares for was a certain height. And of course, investors want the next round to have a higher share price because they want to at some point buy low, sell high. But if that's lower, if the company actually then sells for a lower amount, the investors think of ways of getting their money back first. And so what happened in the case of FanDuel is that the founders, so the actual entrepreneurs who took maybe 10 years to build the company, ended up with €0. Now, we will get to this in webinar 3, but hopefully this for you was sort of an introduction into the world of venture capital and sort of the incentives that drive the behavior. I will take maybe a minute to answer any question you might have. And I just want to say the world of investment and finance is full of gatekeepers in the sense that the language can be a bit weird. The lingo might put you off. Please feel free to ask for clarification on anything. Happy to do so.
Jan, I have a question.
Oh, yeah.
So, if a VC invests and wants in the end to get, after some time, to get the money out, there, I assume, are two main ways. One is the company is sold or an initial public offering.
Right.
But what if the company just turns into a decent SME and the founders don't want to give the control away, so they don't want to sell it? Is there anything that the investors still can get out of this process, or what happens in those cases?
Well, yeah, I mean, they could get dividends. Huh? So, for example, if a company turns a profit, they can return the profit to shareholders every year, and this is a dividend. But this money is not big enough to provide returns for the LPs, and these LPs need to be kept happy in order to raise a new fund. So, in a way, yes, you get dividends, but the money is not good enough. So, investors call this zombie companies, right? And always a large part of venture capital portfolio are called zombies. And it's a little bit of a nasty word because the companies might be profitable, might be an SME, but the investors cannot get out. And this always, in any venture capital portfolio, is always seen as sort of a drag because you need to show up to the board meetings. You need to sort of always wish and pray and find for ways, oh, maybe we can sell the company, but it will take a lot of the time of the investors to be part of those companies, while they will never make the return that you need in order to be competitive on the LP market. But yeah, that's the thing. So that happens a lot. And yeah, what they eventually do, I think you made a great point, and I didn't speak about this enough. I think theoretically and up until the early 2000s, it was normal for a company to eventually see as a liquidity event the stock market. So you will see, of course, you have the S&P 500, but I mean, you can buy shares on the public market of lots of an insane amount of companies. We call these penny stocks. And for private cap, but this sort of has dried up, this IPO pipeline. You see less and less companies going into IPO really because of all the regulation around it, the quarterly reporting. So I think 90% of exits are between either a bigger company and a smaller company or a bigger investor. So, for example, lots of venture capitalists sell their shares to private equity. And if you look in the news now, just open up Wall Street Journal or Financial Times, private equity has a huge problem now because they cannot sell their companies because the stock market's dried up. But I'm drifting away. Any other questions?
I would have a question actually.
Yeah.
Hello, Jan. Thanks for your exposition so far. You mentioned something about maybe I'm mistaken, but let's see if I got it right. The venture capitalists getting around 2% of interest, and then how they make profits is on getting
Right.
20% of the profits, right,
Yeah.
of the company. To which extent that's hold true for angel investors? And if
Well,
so, how does it vary?
this is a great layup, as they say, because I will get to this point later. But the unique thing about angel investors is that they don't charge management fees because they invest their own money. So, and that sort of influences the way they invest a lot. But we'll get to this later. So I appreciate the question, but let's move on. So this was the theory. Like in the same way that software investing sort of has influenced the assumptions and lingo around early stage investing to a degree that's not always reflective of reality, the American ecosystem and their ways of investing are still the way we think about these things, the way I think about investing, but it's not necessarily reflective of how the European ecosystem works. So let me try to explain that for you. So lots of words here. So let's take this time with this slide. So if you go, I enlarged this one. So let's go to the LPs first. So if you look at European venture capital funds and where do they raise their money from, you see that on the bar chart on the left. You see they take a significantly more amount of money relatively from public entities, government money, if you compare that to the United States. And this, what I've been trying to tell you is that the relationship between fund managers and their LPs are crucial incentives that drive the behavior of everything. This obviously has an enormous impact. That means that European investors, for a large part, operate differently than American investors in good ways and in many bad ways. So the thing what you get with government money is that they are not only driven by returns, they are driven by policy mandates. And that can be very positive, of course. So especially around topics around impact and deep tech, as I call it right now, because if you go all the way back here, governments obviously realize that venture capital has changed our world for good and bad, right? And they see that our lives are now being dominated by American technology. So lots of European countries and the European Union say we need to invest more in venture capital because that will create European champions, etc., etc. Often, however, these funds have national or even regional mandates. So lots of funds you will see in Europe are only allowed by their LPs to fund companies within their city, region, or country. And that means that some countries are way better off than others. At the same time, these kinds of it is government money, so there's sort of an inherent, let's say, less degree of risk-taking culture there. So what they will often say is we will only invest our government money if you have a lead investor. So the investor who will actually do the due diligence and who will take the board seat and who will, et cetera, et cetera. Or they say we want traction. We will go to this in the second webinar, but investors obviously want to sort of see a sort of degree of evidence of the growth curve or the degree of which you can capture a certain market. And government VCs are way more cautious there. And this sort of dominance of government LPs influences the valley of death, right? Because if you go back here, most government VCs really want to see a demo first. And they want to see a degree of evidence because otherwise they say, yeah, this is tax money. And I mean, they're not wrong, but that's a big part of why there's such a valley of death in the first valley of death. But then secondly, weirdly, governments also invest directly through their public funds. And what you get now is that the biggest investors in deep tech are actually government venture capitalists in Europe. So the biggest deep tech investor in Europe is actually the European Innovation Council. The second biggest investor is BPI France, and the third biggest investor is KfW from Germany. For good and bad, I mean, those who've been through the EIC process knows that it's a great instrument, but also sort of bureaucratic in the sense that it's I wanted to say a verfremdung, but I don't know the English word. But it's different than sitting in front of a private investor. And of course, then there's also the element of speed, right? American venture capitalists are famous for the quickness with which they can run through a process and invest. Whereas in Europe, it can take 6 months before you receive an investment. And speed is, of course, such a crucial element for the success of a startup. So yeah, then there are other alternatives, so not necessarily unique to Europe, but let's say alternatives that do operate like a venture capitalist, but because of their LP relations and other indicators, they sort of have a slightly different kind of behavior than what we would normally theoretically think as a standard venture capital type of behavior. And these are corporate venture capitalists. So these are funds that have a degree of independence, but they have only one LP, which is a corporate. And this sort of drives their incentives. They're not only looking for a return, because let's face it, the corporate venture capitalist fund is not going to make any different. Not significant difference on the balance sheet and the profitability of the corporation. So that's good. That means that they have sort of other decision things of the ways they decide, and they look for access to the technology, right? Which they can buy as a customer or later can sort of acquire, and that can be very positive for you or extremely negative. Maybe they don't want to see your company succeed and become profitable, big business. They just want to see your technology succeed. So a very interesting dynamic and lots of good and bad examples, but they can be a crucial partner for deep tech, also for bio-based companies, of course. Then you have the impact investors. So this has been spurred a lot by European regulation that you sort of there are sort of different degrees to regulation if you are investing in sort of different types of technologies that have been classified by the EU as being conducive for European innovation, which sort of allows you to get sort of type of regulation or a type of investment from public funds. And that's of course nice if you can unlock a nice chunk of public investment as an LP. So an example here is Green Angel Ventures. This is a business angel network and a venture capital investor, sort of a mix. And if you look at what they look for in a company, they say, and not only if you look at the bottom two, we need an exit plan. We want to get out of the company, buy low, sell high. You need to be investor ready. So things we'll talk about in the next webinar. But we also want evidence of your carbon emission reduction. So that's good. They will look at companies that really have this future vision that can change the world for the better. But of course, the power law is still in place in the sense that the company also has to become a profitable, valuable company. We're still operating under the laws of capitalism, where the LPs need to be funded ultimately with a competitive rate of return. Then we have the family office. Family office, you can see them as a sort of an order of magnitude higher than a business angel, but they can operate very similar like a business angel. A family office is an office that represents the wealth of normally industrial families. These are very wealthy families that sort of want to make sure that their next generation also can benefit from that wealth. You have very large family offices that only represent one family, and you have family offices that represent multi families, like different families. And they are a little bit more cautious because they play a defending game, if you will. So they can be LPs themselves and normally operate mostly in tradable securities, so stocks and bonds. But the thing about family offices as well is that they can act similar ways as a business angel in the sense that their prestige, if you will, is not dependent on the success of the return of a certain investment, but rather in the impact it can make. And therefore, having access to interesting family offices can be extremely beneficial for you as a company operating in the impact space, because if you can tell a story, a narrative on how you will change the world, family offices can be enticed to jump in. Again, something we'll come to in the second webinar, storytelling and articulating a vision for the future. But because they are one of the biggest LPs, so if you go back here, family offices in the middle, in the middle top here, are a large part of the LP mix for venture capital funds. Like everybody's swarming them. Like I've done this in a previous job as well. I mean, you try to get your foot in the door, but they get so much attention. So it's quite hard to get the attention of a family office. And the best way is to get that through a warm intro. But then, yeah, maybe you don't know anybody, and then that can be difficult. But definitely a crucial player to think about. And then finally, angel investing. So dear to my heart, of course, in the start of this webinar, I explained that most of my career I've worked in angel investing. So I'm going to take some time to talk about that topic. Feel free to ask any questions in the meantime. But angel investors are unique in the sense that they are not professionals. These are normally people who have had success as an entrepreneur or are retired or semi-retired after a career that has given them a certain degree of wealth. And they sort of are accomplished individuals sort of as themselves, in the sense that they don't require any prestige to come out of their success as an investor. So they are a little bit more, and secondly, they invest their own wealth. And that comes with a whole host of consequences that are potentially a great opportunity for early stage startups. So again, venture capital funds, if you talk with a venture capitalist, they are managers of other people's money. If you talk to a business angel, they manage their own money and they have the personal say over where they invest in. That means that they don't charge management fees, and business angels will only be remunerated through the exit and the share percentage in the company. So they don't take that extra profit either. So let's go to this list again. So these are individuals who invest their own wealth. Sort of the rule that network managers like I have been say is that, look, you only should invest 10% of your investable wealth. And that means that their professional reputation is not dependent on the investment success. So they do, as I said, they're only paid in profits after an exit. They do not charge management fees. Importantly, they can have motivations beyond return on investment. And this is also crucial, that therefore business angels might invest in companies that are not necessarily able to provide those returns that are competitive with other types of investment products. So that means, in the case of the example Siebe mentioned, a healthy SME that provides dividends or maybe a smaller exit. Business angels, like to be part of that because they can provide their advice. They can be partnering in a very exciting innovation journey, and maybe that's already a degree of which what they want out of the whole thing. They are excited by entrepreneurship and by being part of it, being close to the fire, and therefore they are willing to invest in a lot less scalable startups. Again, they are generally older, experienced individuals, and then therefore they have a lot of time. Business angels don't have a day job, so they can be valuable as mentors. I will add an asterisk there because, of course, you need to be careful with who you are bringing on board. And the thing about business angels is that they are not regulated, so everybody can call themselves a business angel. So saying you're a business angel doesn't mean that you are extremely proficient in the game of investing, nor on the vertical of your own company. So always do your own due diligence on the business angel. But the informality of their nature can be an enormous opportunity for you. The problem, or the problem, the issue with, or the element of angel investors is, of course, that they are not spending institutional kind of money. So normally they have a lot less bigger tickets to invest. And this is, by the way, something that I have been doing a lot as a network manager, is sort of explain to individuals that you don't need to be extremely high net worth to already start investing. So you can already start investing as a business angel with an investment ticket, as we call it, of 25,000 or even lower. It can go low as 5,000. If you group together as a group, as an angel group, you can collect these tickets and actually provide with a sizable investment round. But that means their capacity to invest, that they can only make a difference in the very early stages of a startup, because then the capital requirements are, of course, lower. And that's good, because then you can invest. You need angel investors in the early stage, but they are less useful when you need more money. And angel networks are a great entry point to get in front of investors. So lots of angel investors join an angel network, and these networks are sort of central hubs that provide the deal flow. So they organize the pitching events and they sort of bring the startups to the investors. They do maybe a little pre-check or pre-selection committee to ensure a certain degree of quality. And for business angels, for individuals, this is a great way to pool their capital, to learn from each other, and to access this curated deal flow. And for the entrepreneurs, of course, getting in front of a network provides, visible entry points. So all of these networks here listed as on the website of Business Angels Europe, all of these networks provide you with hundreds of investors, and they organize monthly pitching events. So it's a great way to get your foot in the door. So if you look at what does a strong angel network look like, they have around 200 members. They invest in 13 rounds per year, a lot more than a venture capitalist would. And if you look at the average round, it's around 130K. So that's Europe-wide, so it's not necessarily reflective of Western Europe, but it does speak to, let's say, the lower amount of angel investing. Okay, so we're nearly there. So let's again take a step back. Think about investing as a relay race. So this is better visual to imprint it on your brain in order for your to traverse these valleys of death. You need multiple investors in different time frames, in different periods of risk and return. And understanding how all these different actors operate is crucial for your success. At Meta Group, we pride ourselves in this understanding of the investment world. We know all the key investors in the different phases, and of course can partner with you in the grant phase and then provide that first check capital ourselves. So that's it. Let's do final round again of the key takeaways to make sure you don't forget. Access to finance is a crucial bridge for the valley of death. It's not, of course, an end in itself. It's a means to an end. Understanding the constraints and the incentives of investors themselves and speaking their language will increase your chance of success. If you understand what a investor is looking for and why, you will be able to paint them a picture that convinces them. Venture capital is a subset of private equity with the key characteristics, the long illiquidity period. If you get in, you cannot get out for 10 to 15 years. Venture capitalists are a product to LPs, and the LPs are in a market for many options. The fund math is the power law. Every single investment a venture capitalists make must have the potential to return to provide the profits of the entire fund portfolio. Now, these theoretical assumptions are coming out of the United States, which has a sort of different type of market. European VCs do follow the same language, but it has a different makeup with corresponding consequences. And although both minority equity investors, business angels, and venture capital funds professionals differ because they have different incentives. I am fully out of breath. I really want to thank you for your attention. Again, feel free to ask any questions. I'm putting my LinkedIn and email again in the chat. I would love to have a conversation with all of you on how we can support you in your innovation journey. And of course, looking forward to next webinars, because next sessions will be more practical. We look at ways on how to be investor ready, on your pitch, on your narrative, on your data room, on all the elements you need in order to get in front of investors and convince them. And then finally, on the 14th of April, we go through the investment process, but also look at the deal terms specifically. So what tricks do investors use in order to defend their own interest and so help you with negotiating the best term sheet. So looking forward and happy to answer a couple of questions if there still are. Anything that comes to mind, this is the time.
There is one question in the chat.
Okay.
Yeah.
I'd love to see an example of a finance timeline based on a business plan, depending on a certain technology readiness level. So if I have already TRL 6, 7, or 8, what should be my finance timeline? What investor should I contact in what phase of my company?
It's going to be
information and raw. Yeah, it's a big question, I know.
No. I mean, this is the crucial question, of course, and definitely exactly the question we want to get into the second webinar. What I can maybe do.
Because I'm not it's particular to me. I have cash flow plans and not business plans. And in my cash flow plan, I always see where I'm going into negative. How I should address this? What timing should I take into account to not be in the negative?
I mean, this is very specific. I think from the key point I have been trying to get across from this webinar, and maybe I should have said it more explicitly, is that any equity investor that enters your company normally puts in their term sheet. So in the contract, let's say that you will ultimately sign with the company or as part of the share purchase agreement, they would say, if we have the opportunity to exit your company with a profit, we can do so after 4, 5, 6 years. What I'm saying with that is that the equity investor will take any opportunity to sell its shares of the business after only such number of years. So that's the timeline that you need to present in your fundraise to investors, saying like that's a timeline where we can provide you with the opportunity to sell. I hope that's clear, but that's a typical timeline you would see, and then normally every investor knows that's going to take longer. Normally it's only after 10, 11, 12 years that such an exit can take place, but maybe that's the start of an answer.
Yeah, it is.
Yeah.
And maybe something to keep in mind. That's something I'm also a little bit worried about. And that is people investing in your company to address the machinery you need to buy. Normally, it's most like scale up or level up or something. You have a certain level. You have proven you will have something, but we need to accelerate. But it's, I think, very difficult to find people that invest in machinery and investment and in land and in buildings and
Yeah,
on
absolutely.
capital. So
Yeah, absolutely. And unfortunately, I haven't been able to find the time to talk about debt funding, but should be on the radar of anyone who's trying to fundraise, because equity is something you can only give away once. You have only a set cards in your hand. If you attract debt funding, of course, you do not give up any ownership. And normally in the late stages, debt funding is a way to purchase machinery, because then you have some sort of degree of value you have to underwrite the loan with. But in the early stages, this is absolutely a problem. What venture capitalists sort of try to offer to potential portfolio companies, because what I should have maybe added as well is that beyond the cash on the company's bank account, venture capitalists also try to offer value in other ways. Is, for example, that they buy up shared lab space for all the portfolio companies. So also corporate venture capitalists look for ways to provide such added value, because you not always necessarily need to acquire the machinery. You can also have it as a service, and that can be part of the bigger matrix a venture capitalist can offer.
correct. Thank you.
Jan, I have one more question.
Yeah.
Do you have any insight or some secret way that you can suggest us about where to start looking for relevant investors? Because for venture capitalists, you did mention like the deal room, so you can go look at investors that have already invested in startups in a similar field. With regards to the business angels, there are these networks that you can look for. But do you have any other secret? Because it seems a bit scattered, right? The information. So is there
Absolutely.
any
Yeah.
other way to find such type of relevant investors for specific sectors?
Yeah, I mean, there's lots of people operating in the market who sell their services to do exactly that. So M&A, corporate finance advisors role are exactly that. They do this literally. They help you, they connect you with an investor, they help build your slide deck and your financial model, and ask for a 2% success fee. So with caution, because they can be extremely helpful, especially in later stages. They can be a great way to literally outsource that part of the job. This is what M&A advisors and investment banks do. But at the earlier stages, that might be more difficult. And I agree, I don't have a clear answer to that. That's part of the game. And for startup CEOs, most notably, fundraising is the largest part of their daily life. You need to talk to many investors, tens, in order to get your foot in the door. And yeah, go to places like Dealroom, PitchBook, but also on LinkedIn. But this is something we'll get to in the next two webinars, because the first contact you have with the first impressions you give to an investor are crucial, and the amount of bad impressions I get from founders who try to get in touch with me is eye-watering. So don't start adding investors to your LinkedIn. Please be a little bit more careful, but join me for the next webinar to find out.
Very good.
Yeah, I also have a question about specifically forest sector innovations. In your opinion, is there like a specific investor type that is more likely to invest specifically in forest sector innovations, or is it not so relevant to look at that?
Yeah, no, definitely. So if you go back to this slide, right, where I say, what am I doing? Share, am I sharing the screen right? So when you look at what venture capitalists actually offer to LPs, the people and the institutions with the money, is access, right? They say we have a particular access to type of deal flow because we know the industry. So that's why almost all venture capitalists are mandated by the LPs only to invest in a certain industry and on a certain timeline. So definitely, I wouldn't say the forest sector specifically, but you could imagine the forest sector be part of impact. There's a colossal amount of impact funds that have attracted government LP money because they are contributing to the decarbonization of Europe. So you could imagine forestry investments being part of that, but also other sectors. Obviously, it's quite a broad sector. You and Siebe warned me not to focus only on wildfire startups, but also on other types. But definitely, yeah.
Yeah, thank you.
I also have one more question, Jan. You already mentioned mentorship in few of with the different investor types that they also provide mentorship. For example, also the corporate VCs that have a very good knowledge about the specific sector, but also the other type of VCs that mostly invest in a certain sector, so they might know very well that sector. But in terms of mentorship, if you compare it in between business angel, VCs, etc., where do you find that typically there would be more mentorship involved, or what are the additional benefits in addition to finance if you compare the different type of investors?
I mean, I'm biased. I believe in the power of angel investors. What you often get, and it's something we'll get to in the second part, is that venture capitalists, the large degree of money that you raise are refinancings. So that means that you need to, because of a customer who's paying too late, often government customers pay too late, and suddenly you're faced with a cash flow crisis, and you need to knock on the door again of your principal lead investor. That can be a venture capitalist. And they often then say no, because they have the portfolio in mind, and they only want to reinvest part of their fund money in when the funding has a chance of producing the desired return success. What I'm saying with that is that often venture capitalists can lose interest in the success of your company if you don't. And then secondly, myself as well, I worked in a venture capital fund. To a degree, you can say, look, what can I say as a manager to help with the success of a company? Whereas business angels often have been entrepreneurs themselves, so they understand what it means to hire and fire people. They understand what it means to what the office politics can have an impact on the company's success. They understand what it means when customers pay too late or when a customer cancels their subscription. So I think the mentorship and wisdom angels provide are an enormous asset to entrepreneurs. I think that the venture capitalists look more at the business model, obviously the finances, which are a crucial part, etc., etc. So there's different levels. And then the most important thing is access. Can investors help you get a foot in the door with certain types of customers? That should be the most important thing, because ultimately it's all about customers and customer success. Very broad answer. Again, something we will go into the next webinars. I have time for one more from Anne. Nice to see you again.
Hello, nice to see you. So maybe this will also lead into the next webinar, but one thing that I really love about your presentations is how humane and human you make the topic and how you encourage the innovators. And I think asking for money is something that in our society is always a tricky bit. Trying to appear competent by espousing the right jargon and so on, as you have acknowledged repeatedly, kind of hurdles, perceived hurdles. And I just want to invite you to make another encouraging statement about how you feel that from the investor's perspective, being human as you ask for money can be acceptable or even useful, or just something that is part of what is happening anyway, and people should not hold back on the basis of being a little insecure about this.
Yeah, no, I mean, investors are waiting to be convinced about the potential of the opportunity that you're chasing, because they only have a limited knowledge of the sector. They think in outcomes, and therefore they are very, especially business angels and family offices, but any investor is susceptible to the story that you're telling to them about because they understand that they want to seek success in 10 years. So paint them that picture. And then secondly, what I want to ask is, investors aren't the know-it-alls or the best people themselves, as in, if you look again at the success rates I've shown of the types of returns that venture capitalists make to their LPs, being an average investor is not good enough. So investors themselves, especially the professional investors, are under pressure to perform because they need to raise their next fund. So they are insecure themselves as well, because the way you talk to a professional venture capitalist, that's exactly the way they talk to their LPs. They also need to fundraise. So don't feel intimidated by them, because it should be the other way around in that sense. And yeah, that's what I've been trying to convey. So don't be scared to talk to them, and be confident about the story that you're telling.
Thank you.
I have to go.
Thank
It was
you.
a pleasure. Add me on LinkedIn, send me an email. Thank you, Leah and Siebe, and looking forward to seeing you on the next one.